So we are supposed to begin from here, right? Now, primary market. No? From here we are supposed to begin. Okay. So primary market, then underwriting, best effort basis, shelf registration. Okay. So primary market means what? So primary market as in now it is a market wherein, so let's say IPO. So there is a company. This company is raising capital from the public. Okay, so when a company is raising capital from the public for the first time, it is called as initial public offering. Okay, it is called as initial public offering. And so that means what happens in an IPO? Companies selling shares. Companies are sellers, they are selling shares, and investors are buyer, they are buying shares. Okay, sellers and buyers. So now whenever there are sellers and buyers, it becomes a market. So now we have to do a naming ceremony. We have to name this market. So we will name this market. Now this is a market. Now this is a market where new securities are being bought and sold. So market where new securities are being bought and sold, because it is new, we call that as what? Primary market. Primary market. So what do you mean by primary market? Market where new securities are bought and sold. Okay, primary market is a market where new securities are bought and sold. Okay, now in this IPO, so IPO happens in the primary market. Now there are some other debut issuer. Debut issuer means this is the company which is issuing shares and raising capital. So they are debuting. That means they are first time they are entering into the market, and then they are raising capital. I mean, here from the public they are raising capital. Now underwriting offering means what? Now this company, say for example, this company is let's say Zomato. Now this company is Zomato. They know to deliver food. They don't know how to raise capital. That is not their area of expertise. Okay, so they know to deliver food, but they don't know how to raise capital, because that is not their expertise, right? So what will they do? They will go to the expert. So who is that expert? That expert, just like imagine, if I'm not keeping well, what will I do? Health is mine, but then I'm not an expert in all these health issues. I'm not a doctor. So what will I do? I will go to the expert. That expert is called as what? Doctor. Similarly, here also they are going to the doctor. That doctor is called, that doctor is investment bank. Okay, that investment bank, or precisely it is called as underwriter. Let me use the word underwriter now. They will go to the underwriter. Now, who acts as the underwriter? Typically, an investment bank. So now, underwriter, so they will approach the underwriter. So now this underwriter is the expert in studying the health of the company and advising them how to raise capital from the market. Okay, so that's why they are approaching the underwriter. So they are also called as lead managers. Okay. Now these underwriters, when they study the company and they enter into a tie-up with the company to raise capital. Okay, so now the kind of services that this underwriter enters with the company, there are two types. One is best effort basis. Best effort basis. Another one is proper underwriting. Now in best effort basis, company says, I mean, this investment bank says, that look, I will do all the formalities. Formalities means what? Formalities is in all documentation work to be done with the regulator, that is SEBI. SEBI in India or Securities and Exchange Commission in US. So I will do all the formalities, documentation work. I will do all advertisements, all. But however, I'm not guaranteeing anything. I will be doing everything best effort basis only. So whatever subscription happens, I mean, whatever investors are subscribing. Otherwise, I am not bothered. Okay. So that is this offer, best effort basis. Another one is underwriting. So underwriting is like a guarantee now over here. Now in underwriting, what happens? Underwriter will say that look, I will take up the guarantee. So I will make sure that all your shares are sold in the market. And in case if it is not sold also, I will take it up. Okay. In case if it is not sold also, I will take it up. Okay. So obviously then the charges will be higher. Typically they charge like, 1 to 5% of the issue. So if it is 1000 crore, just imagine 1 to 5% of that amount they charge. So that is underwriting. So underwriting is guarantee wherein they will uh, actually how it works is they will buy and then they will resell it back to the investors. That means they have taken the guarantee. So company is tension free now. Okay, they will buy and then they will resell it uh, back to the buyers. Okay, so this is what it means: underwriting best efforts basis. Then shelf registration. So shelf registration means in a shelf registration, bond issue is registered with the securities regulators in its aggregate value with a master prospectus. That means master prospectus. Aggregate value means what? Companies like, imagine Muthoot Finance. Now they do the work of giving gold loans. Now when they do the work of giving gold loans, the question is, when they do the work of giving gold loans, who is giving them? So Muthoot Finance, who is giving them money to give loans to the public? So what they do is, because we are not keeping any saving account with Muthoot, right? If it is HDFC, ICICI, we are doing saving accounts. So that money is routed further. But then with Muthoot Finance, we don't do any saving account. So how does this work? So what do they do? They keep issuing bonds. They keep issuing bonds. So when they keep issuing bonds, they get money from the market. Okay, public or investors, they invest in those bonds. So people, so they imagine they are people are investing, and Muthoot promises them to pay 8%. Now Muthoot has got no money. That money is further given to some gold loan borrower. Gold loan borrowing. That means somebody will come with his gold. He will give gold, and then Muthoot will, as the security, he will give gold, and Muthoot will give loan to that person. Okay, so this is how it works. Okay, now if Muthoot keeps on issuing bond all the time they cannot keep going to the regulator and keep doing documentation work. This will eat up their time. So what will they do? They will at once, bulk documentation, as in bulk, they will register that I'm going to raise 1,000 crore in the next, this next, 1 year or so, and then next 1 year, next 2 years, and then they will, after every few months or so, they will keep issuing bond, 200 crores, 500 crores. They will keep issuing bonds. So that is called as shelf registration. Okay, a bond issued is registered with the securities in its aggregate value. So total 1,000, 2,000 crore they are going to raise capital for in the next 1 or 2 years. So all that will be specified so that they don't have to keep on going to the regulator asking for permission. That is self registration. Okay. Then subsequent repeat issues of fixed income securities usually takes less time, right? That means again and again when they go to the market to raise capital, it will be very easy for them. Okay. Then secondary market means what? Now this is all primary market. Now in primary market, okay, now in primary market, if people are buying shares, now quite possible that after buying they might not be interested after a few days, weeks, months, years after. So what to do? Now they cannot go back to the same company again and say like, I don't like your company shares, now take it back. Company will say like, I have already invested that money, I cannot give it back to you. Okay. So what to do now? How do they exit? So now there is another market for exiting. It's just like you are buying some product in the non-financial world, imagine mobile, and then after a few months, years down the line, you don't like that phone anymore. You may not be able to go back to the dealer and then again sell it. Then what will you do? You will go to OLX, and then you will sell it to somebody else, the second hand product. Similarly, for those second hand product, here also one market is there. Okay, here they will sell it over here, and other people will buy it. Other people will buy it. So now this is also a market. Okay, this is also a market where buy and sell activities are taking place. Now this is a market where buy and sell activities are taking place. So this is market, and this is called secondary market. Secondary market, and together secondary market means what? Where existing companies, it is not new, existing company shares are being bought and sold. Existing company shares are being bought and sold. That means not new. And together this primary and secondary are called as capital market. Together this primary and secondary market is called as capital market. Okay. Okay. So capital market comprises of both primary and secondary market. Okay. And what is capital market? It comprises of both primary and secondary market, and it is a market where long-term securities are traded. Long-term means maturity period more than 1 year, or equities where no maturity period is there. So long-term securities are traded in the capital market. Then distressed debt. Distressed means something like nowadays you can say Byju's, the distressed one, right? Is a name given to bonds of issuers that are in or expected to file for bankruptcy. So whatever bonds they have issued, those all will be distressed debt. Or any company which is not able to pay off its lenders interest on time, those all are distressed debt. Okay. So okay, reading 50 now. Fixed income markets for corporate issuers. Now short-term funding for non-finance corporations. Muthoot is an example of non-finance corporation. In India, we say non-banking financial companies, NBFC. Okay, non-banking financial companies. That means these are finance companies, but non-bank. They are not bank. NBFC. Okay, so a non-financial company usually raises external funds for investments in short-term assets, cash, or short-term investments, account receivable, and inventory through financial intermediaries that provide either loan financing or securities lending finance. Okay. Usually raises external funding for investments in short-term assets through financial intermediaries that provide either loan financing or securities-based financing. Okay. So external financing, and then uh, external financing. One second. Okay, wait. Yeah. So how do they finance? That means how do they raise capital? Okay. How do they raise capital? One is uncommitted line of credit, committed line of credit, and then revolving line of credit. So I'll begin from this last one. Revolving line of credit is very similar to credit card. Now, what happens in a credit card? So, in a credit card, imagine if you have been given the credit limit of 1 lakh rupees. Okay, per month you can transact for 1 lakh rupees. Now, imagine um, you have utilized this money, okay, for shopping in this month itself, and then immediately you have paid also. Now, immediately if you have paid, then again you will be eligible for 1 lakh for next round, next month again. So again, if you have utilized this money, again you will be eligible for 1 lakh. So this is revolving line of credit. Now the bank is giving you credit 1 lakh rupees. So you can use it, and again you will get this loan. Okay, that is called revolving line of credit. Similarly, you think from company's perspective, to get, to when they require money for working capital. So for their working capital requirement, bank will give them this facility. They will utilize it, and then again once they pay, even if they use partially, let's say 30,000, then again when they pay this 30,000, it will become total 1 lakh. Then again, they will use it for their working capital. So again and again they can use this credit card. Okay. So that is revolving line of credit. So because every time you are getting again and again, so it is called as revolving line of credit, which is used for operating business, okay, or business operations. Okay, to run the business, your business tend to use revolving line of credit. Then the next one is committed line of credit and uncommitted line of credit. Uncommitted line of credit means what? Say for example, you want to, you are planning to get one housing loan, but you have not fixed the house yet. So you are planning, you want to know what is the loan that bank will be interested to give you, because it should not happen that you are taking a, or you are planning to buy a house for 1 crore, and bank says that you are eligible only for 60 lakhs, 70 lakhs. Then, so you need to know beforehand itself, like what sort of home you should be searching for. So you are going to the bank. So you are going to the bank, and okay, when you go to the bank, you are saying, look, bank, uh, look, bank, uh, this is my salary slip. Bank, you are asking, like, tell me what is my eligibility. Bank says, give me the salary slip. So they are studying your salary slip. And then they are saying, look, you are eligible for 70 lakhs. Now, when you are eligible for 70 lakhs, okay, so now when you are eligible for 70 lakhs, so um, does that mean now you will immediately, go and book your home, and the bank will for sure give you 70 lakhs? No, it is not a guarantee. It is an uncommitted line of credit. So they are giving you a credit of 70 lakhs, but it is uncommitted. Why? Because who knows what sort of home you have booked? What if this home is illegal? This home might be illegal as well, right? So that's why it is an uncommitted line of credit. So when you book the home and again take all these documents to the bank, they hold the right to reject your loan. They might say that I don't want to sponsor or give a loan for this home. That's it. So that's why that time they have the right. That's why it is called what? Uncommitted line of credit. Now, what is committed line of credit? Okay, committed line of credit means, now committed means, imagine you have already seen your home. Okay, now you have seen your home for 50 lakhs, and then you are going to the bank. Then you are showing your salary slip and the home papers also. home documents. Both you are showing. So in this case, what will happen in this case? Now, because you are showing this home loan documents as well as salary slip, both will be checked by the bank, and then they are saying, okay, for this home and for this salary slip, we are okay to give 50 lakhs loan. Now, this is called what? Committed line of credit. In the same way, business wise also, committed line means business says, or the bank says, we are committing to give you this much loan. Now you do whatever working capital you want, because we already know your business. So we are committing to give you this much of loan. Uncommitted means the bank has the right to say no to you anytime. Okay. Then renewal risk means whether you will be able to renew it or not. Committed. So it is committed now. And then after that, whether they will again commit or not after this loan gets over, now that is a doubt. So that's why renewal risk. Okay. The next one, secured loans. Secured loans are backed by collateral. So the name itself says secured. Example, all these are the collateral. Then factoring refers to actual transfer of credit granting. Factoring means, you must have done in your college that bills receivable, or that you get bills of exchange or bills receivable. So imagine you have bills receivable, and then, so which that means it is an acknowledgement that you will get money maybe after 3 months or so, let's say, but you want it immediately. Then what will you do? You will take that bills receivable to the bank. Okay, when you take it to the bank, what will the bank do? Bank will say, like, okay, fine, I will give you the amount, but let's say the bills receivable is 100 rupees. So the
Factoring, right?
factoring, yeah, bills receivable is 100 rupees. Banks will say, I will give you 90 rupees, and I will take 100 rupees from the one who issued bills receivable. Okay, so that means in this case, bank is getting what? 10 rupees profit. Correct? Have you understood what I said now, or not clear?
Yeah,
Can you
got.
explain again?
Huh?
Can you explain again?
Huh. Okay. So bills receivable or trade receivable. Imagine you have 100 rupees, okay, as trade receivable. Now you are going to get this money after 3 months only, right? So when you are going to get this money after 3 months, but you need it urgently. Imagine you got one contract, and you have to quickly start making products now. So you have to manufacture goods. Now what to do? This guy, this debtor, okay, this debtor, or he has assured you that he will pay you after 3 months, and he has given you some written assurance, which is called as bills receivable or trade receivables. So now you are approaching the bank. You are saying, look, bank, I have to wait for 3 months. Instead, you wait for 3 months. Okay, and I'm giving you all the documents. You take money from my debtor or the trade receivables. You take money. Bank says, okay, fine, I will do it. And you are saying, you give me this amount. Bank says, okay, I will give you, but I will not give you all 100. I will give you 90. Okay, and bank will wait for, let's say, 3 months, and then they will take 100 from the account receivable, or this trade receivable or account receivable. These are interchangeably used terminology. Okay, account receivable, trade receivable, bills receivable, all these are interchangeably used terminologies. So they will take this 100 rupees from the trade receivables or account receivables. So now I have 90 rupees in my hand. Now with this 90 rupees, I can quickly start my production work, right? So this way I can manage this. Have you understood now?
Yes, sir.
This is called factoring. When I'm taking my trade receivables to the bank and discounting it, and then taking the remaining amount and using it for operating my business for working capital requirement. This is called factoring. So it refers to the actual transfer of credit granting. Credit granting means here account receivable, and collection of receivables to the lender, to your lender at your discount. Lender here means bank, at your discount from their face value. Face value is 100. So I will get at your discount, let's say of 10. So I'm getting 90. Okay. Then external security based financing, commercial paper. Commercial paper, I think I explained it right in money market itself. Money
Yes,
market
sir.
instruments. Okay. Yeah, that one, commercial paper. Then bridge financing. Debt that is temporary until permanent financing can be secured is called bridge financing. Okay. Say for example, bridge financing. Say for example, you have taken a loan to build a building. Now, if you have taken a loan to build a building, you need another loan to clean this space, because you have to first of all clean the space, then only you can build the building, right? So this cleaning space is what a bridge, small bridge financing you are taking, so that you can clean this place and you can build one building over here. Okay. Then rollover risk. Rollover risk means what? Commercial paper means this is an unsecured way for a company to borrow money. Now here is the borrower. Okay, now here is the borrower and here is the lender. Now uh, when commercial paper is often reissued or rolled over when it matures, okay, the risk that a company will not be able to sell new CP to replace maturing paper is termed rollover. That means uh, the risk that a company will not be able to CP is often reissued or rolled over when it matures. The risk that a company will not be able to sell new commercial paper to replace maturing. That means, see, normally, imagine they are borrowing for 6 months. Now, after 6 months, they tend to roll it over. Roll it over means it's like another new commercial paper. So they will say, this borrower will say, look, I don't have money to pay, but let's do one thing. I will keep paying you the accumulated or the interest amount. Let's do one thing. We will roll it over now. So roll it over means now you make it like 12 months. 12 months. So you keep extending. So now the lender, no, let's say lender is agreeing. If the lender is not agreeing, that is called as rollover. That is rollover risk. CP is often issued or rolled over when it matures. That means instead of paying, they are extending the time limit. That is rollover. The risk that a company will not be able to sell new CP to replace maturing paper is termed rollover risk. That means if you are not able to extend this maturity, then that is called as rollover risk.
So, like say, it can extend like up more than 1 year, right?
They will keep extending after that, right? But it is like issuing a new commercial paper. It will be shown as if like new commercial paper is issued.
Because it's a money market instruments, right? Uh, this one. So, in that sense, like I'm seeing, as in
Yeah,
it
it
can't
is a
be.
money market instrument, but it is a newly
Yeah,
issued again, right?
yeah.
So it is again for new 6 months.
Okay,
It is again for new 6 months then.
got it.
So this is a risk for the company, right? Because there's a chance that the bank might not extend.
Yes, if the lender does not extend, that is why it is called rollover risk. Rollover risk. You are rolling over, but the lender is not agreeing now. Then that becomes rollover risk. So that's what it says. A company means here the borrower will not be able to sell new commercial paper. So what is he doing? He is only selling commercial paper, and then next at the time of maturity, he again sells it. So he keeps selling that commercial paper. If he is not able to, then that is called rollover risk. Then this is one terminology. A smaller, less liquid international market in commercial paper also exists. So also called, this is called as Euro commercial paper. So similar to US T-bill, commercial paper in the US is typically issued at a pure discount security, making it a single payment equal to the face value at maturity. This is what we discussed in the money market. Now there is internationally known market, smaller, less liquid market. This is memory based question. Euro commercial paper. Okay. So less liquid international market in commercial paper is Euro commercial paper. Okay. Then CD we have discussed, certificate of deposits. This is straightforward one line explanation. Interbank fund means funds that are loaned by one bank to another. So many times it happens that one bank is borrowing money from another bank. Why would one bank borrow money from another bank? For various reasons. For example, they have to maintain that CRR. You know what is CRR? Cash reserve ratio?
Yes.
Yes, sir.
You know, right?
What
Okay.
is the amount that a
Cash
bank
reserve.
has to maintain with?
Yeah, cash reserve ratio means that is the cash reserve ratio right now. I think it is 4% somewhere. It would be cash reserve ratio means if 100 rupees bank is getting from your depositor, bank cannot use all 100 rupees for lending money. They have to keep some money, say for example 4% CRR. So they will keep this money with the central bank, for which they will not get any interest. Okay, that is called CRR.
So it was 25%, right? Like not now.
No, that is no, not now.
That is a
Long back,
different. Okay.
long back.
Yeah.
Now it would be around 4% only. If you want to see, you should go to rbi.org.in. I'll just
I'll
show
just
that to you.
search. Uh,
See here, RBI, this one, .org.in. Here you will find reserve ratios, 4%. Okay. So in order to maintain, so at times what happens is, imagine a big borrower came here. He has borrowed money highly. So they may not be able to maintain this 4%. Though, so if they don't maintain, they will be penalized. So for that reason, they will borrow from another bank, and then they will keep that money with the central bank. Okay, so that is, so at that time when they borrow, they have to pay, right? That is called as interbank funds. Okay, then another reason can be like, this is just one example. Another reason again, when borrower is borrowing highly, so at that time, imagine they don't have enough money with them, so they don't want to say no to the borrower. So what will they do? Rather, they will borrow from another bank. At that time, they will borrow money from another bank, get money, and then give it to this borrower. Okay, so that's why
this is interbank,
interbank
right?
means bank to bank,
Bank to bank.
when
Yeah.
they are borrowing.
This one. Like
Okay,
this would be for a day or so, right?
yeah, a big deal
Okay.
is going to happen. Imagine big borrower came, then he says like, I want so much of money, and the bank does not have enough cash, so they can borrow from another bank. Okay, then central bank, another source of short-term funding for bank is to borrow excess reserves from other bank in the is to borrow excess reserves from other banks in the central bank fund market. Central bank fund market means from the central bank. Okay, they are borrowing. Like we have repo rate, right? In India, repo rate means what? Banks can borrow from the central bank. Okay. So banks with excess reserves lend them to banks that need funds at the central bank funds rate. That means repo rate. In Indian version, it is repo rate. Okay. Now, then commercial paper, I told you it is an unsecured one. But again, these are all some interchangeably used terminologies. If anybody is asking commercial papers are secured or unsecured, you have to say it is unsecured. Okay, even in questions, if it comes, it is unsecured one. Okay. Then, so asset-backed commercial paper. So this all, just see if you are able to understand all this. Asset-backed commercial paper creation process. A financial institution transfers collateral. So because it is asset-backed, okay, so it is collateral is involved. Is transfers collateral to a separate legal entity called a special purpose entity in return for cash. The SP is set up as an off-balance sheet vehicle with respect to the financial institutions. The SP sells ABCP to investors who accept the risk and return of the collateral backing the ABCP. The sponsoring financial institution provides a backup credit liquidity line. Okay, so what does that mean now? A financial institution transfers collateral. So there is a company which is interested in issuing commercial paper. They want to capture the market in commercial paper. So now this is the company, okay, which wants to capture the market. So they want to play the role of a lender. So what do? Now they are creating a separate entity, special purpose entity or special purpose vehicle. Okay, a financial institution transfers collateral. So this is that financial institutions. Okay, transfers collateral to a separate legal entity, usually existing short-term loans made by the bank. Okay, to the special purpose entity in return for cash. Okay, so they are getting cash and they are giving loan collateral. Fine.
So this is also like factoring, right?
You can think like that. Yeah.
So this would be a bank, right, and not a company. Or
This would be a financial institutions. Yeah.
okay, so yeah.
Financial institution transfers collateral, usually existing short-term loans made by the bank. Okay. Yeah. To a separate legal entity in return for cash. The SP is set up as an off-balance sheet vehicle with respect to the financial institution. Okay. The SP sells ABCP to investors. Okay. So now they are selling ABCP to the investors. Now, when they are selling ABCP, okay, now to the investors. Sells ABCP to the investors who accept the risk and return of the collateral backing the ABCP. The sponsoring financial institution provides backup credit line. Okay. So here is the investor. Okay. So that means here is the investor, right? So they are giving collateral. Acha, so money is okay. Sorry, money is flowing like this. Then see, money is flowing like this. Money is flowing in this direction. Like he is the lender actually, and this SPE is the borrower. Okay, money has come here, so they are giving money to the borrower. They are giving collateral. So basically, one intermediary they are creating. Okay, and that money, that borrowed money, they will give it to this company, and this company will keep your collateral. Okay. Have you understood this one?
So here the SP is issuing bonds.
Yeah. So
Is
they
it
created so that it doesn't look like, this company is uh,
a separate company?
borrowing commercial, this company is issuing commercial paper. Who is issuing commercial paper? SPE.
SP.
This SPE is issuing commercial paper and they are borrowing. So it will not be reflected in their balance sheet. That's
So
why
this is
this
similar to what
commercial
we did that day. Like yeah, the bank is
mortgage-backed
itself, the
securities kind
company
of
is
thing.
MBS. So the
This is
SP is not a different company. Like it is a subsidiary of.
subsidiary. Yes, this is called off balance sheet.
Of
Off balance sheet. Where is it? Off balance sheet. So vehicle or off balance sheet liability, you can say. This is off balance sheet liability over here because this, this SPE is borrowed. Now on the record, who has borrowed? SPE has borrowed. Now, what have they done? They have just sold their collateral and they have raised capital that way. So they are not borrowed. It doesn't look like they are borrowed now. SP is borrowing. Okay. Shravan, you understood this one?
Yes, sir.
Okay. So finally, this collateral is unsecured only, but then it is backed by this company. Okay. And it is not shown on the balance sheet. So such uh, liabilities are called off balance sheet liabilities, okay, which is there but not shown or not existing in the balance sheet. Okay. Okay. Now repo and reverse repo. Now we already did, that explanations, okay, like what is repo and what is reverse repo in, I think, last to last session or so. So this is the graphical presentation. So there is security, there is, lender, he is and there is a borrower. Borrower is giving collateral and he is taking loan amount, and then at the time of maturity this borrower is giving back the interest, loan and interest, and he will take back his security and he will walk away. That is repurchase, repo, reverse repo, shortly repurchase agreement. Now there is a sum related to this, interesting one. We'll do this sum. Okay. Initial margin repurchase. Okay, so how does this work? Initial margin is, okay, the question is not properly given here, right? So I'll just take a minute to frame question. Okay, initial margin is 103 percentage, then 103, repo rate is 2 percentage. Then uh, repo agreement to sell a bond today. So when they are selling, that means this is the value of the collateral. So collateral value is 1 million. Okay, $1 million collateral. Okay, and then So the question is, what is the amount borrowed? First question. Second question, after um, after 30 days, if the after 30 days, if the value of the collateral is, after 30 days, if the value of the collateral is 990,000, what is the variation margin? This is the question. And so 90-day repo. Ninety-day repo, initial margin is 103 percentage.
So
Repo
can we
rate
have
2
a break
percentage.
for 10 minutes? Like, I love dinner.
Huh?
Can we have a break for 10 minutes? Like, I love dinner.
Okay. Fine. So we'll connect then after the break.
Yes, sir.
Okay.
Then continue with the song.
Okay, fine. So we'll just take a break for 10 minutes and then we'll connect. Okay. Once done, you just put your message in the group.
Okay, sir.
Okay. And then we'll continue. So you just leave it as it is. Okay.
Okay, sir. So leave, quit now.
As it is. You just, no, you just keep it on only. Let it be like this only.
Okay, okay.
Yeah. You just put your message in the WhatsApp group and then we'll continue. Okay.
Okay, thank you, sir. Hello.
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 Hello. Yeah. Yeah. We'll just wait for Shravani to join in. Okay.
So we can continue.
Ha. Okay. Okay. You can see the screen, right?
Yes, sir.
Okay. So this is the sum. Now, what do we have to find out? What is the amount borrowed? See, the initial margin means the collateral amount that they are paying is 103%. That means, okay, so that means if borrower is here and lender is there, borrower is paying 103 rupees to borrow 100 rupees. Okay, so his collateral value will always be higher than the borrowed amount. Okay, because then only the borrower will have the reason to repay the amount, right? Okay, so this is what 103 percentage means. If the borrowed amount is 100, 103 is the loan. Now the collateral value is, so this is the collateral value. Collateral value is 103 if he is borrowing 100. Now what is the collateral value? 1 million. So if 100 is the borrowing, collateral value is 103. If collateral value is 1 million, what is the borrowing? So you just have to cross multiply. Can you find out?
Nine lakh 70,873.
So in order to borrow this, the borrower will pay how much? $1 million. So borrower, lender, he will get how much? 970, 873, and he will give $1 million as the collateral. So this part is okay. First part.
Yes, sir.
Okay. The next one, after 30 days. So this borrowing is happening for 90 days. Okay. 90 days and 2% is the repo rate. 2% is the repo rate. So now after 30 days, what happens? See, after 30 days, if the value of the collateral is coming down, it has come down. So let's see what happens after 30 days. First of all, after 30 days, how much is the interest accrued? 2%. That means 2 by 100. 2% is for 360 days. Okay, so the convention is to use 360 days instead of 365. So we will follow the same for commercial paper, 360 days. So
It will be 90 by 360.
So it will be 2 rupees is the 2 rupees is for 100. Okay, for 1 million, how much for per year? Right now I'm calculating for per year, then I will proportion it. So that comes to sorry, borrower did not borrow 1 million, right? Borrower borrowed to 978.73. Let's calculate this.
$19,417.46.
Okay, 19,417.
Yeah, 0.46.
Okay, fine. So this is for one entire year. So that means 360 days. How much will it be for 30 days? Just calculate for 30 days. Anyways, the actual borrowing happened only for, see, this is also, the actual borrowing happened only for 90 days, correct? It's a 90-day repo. So, okay, let's calculate 90 day, how much it comes to 90 day.
So it's 4854.25.
Okay, so this is the total interest at the time of maturity, okay, that the borrower is supposed to pay. So he's supposed to pay 970, 873, correct? 873 only, no? Right? And plus, along with 970, 873, he will pay 4854 also. Okay. However, now 30 days are over. So 19417 is for 360 days. For 30 days, how much? Just calculate. For 30 days.
This is 1618.08.
Okay, 1618. Let me just check here. Yeah, correct only. 1618. Acha, they have taken 970, 874. We'll also take that number only, 874, just to match it with the book. 74. So is this coming to then 19418? Just calculate this again.
Yeah, it is the same 19,417.4.
Okay, fine. And what is this? This also 16. Here it says 1667, 972, 492. 972. Oh, 1 second. Wait. This is 972, 492. Acha, no. Sorry. It's all correct only.
They've added the interest, right?
Yeah.
We didn't add it, so
We are supposed to. Yeah. Just 1 minute. Um, After 30 days. So this is the interest accrued. Okay. So this is the interest accrued. So I think some decimal difference will come. That is all okay. Okay. So now this is the interest accrued for 30 days. That means after 30 days, okay, after 30 days, This is the situation. Borrower is there and lender is there. Borrower has borrowed how much? He has already borrowed 970, 874, and plus now after 30 days he is supposed to, the interest accrued is 1618. So I will add that as well. It is as good as he has borrowed that amount also. But when it comes to collateral's value has come down by 10,000. It has come down by 10,000 to 990,000. So 990,000. Now lender, lender will say, look, always initial margin, always initial margin is supposed to be 113, 103%, right? So if this is the loan that the borrower has borrowed, so 100, if it is borrowed, the collateral should be 103. So 990,000, if it is borrowed collateral, sorry, if 990,000 is the collateral, sorry, not 990, if just add up these two amount, this amount 97874 plus 1618,
972,492.
972,492.
Yeah.
So that means 972,492 is borrowed. Imagine 972,492 is borrowed. Then how much should be the collateral? Cross multiply. So it will be 972,492 into 103 divided by 100.
So it is 1,016,666.7.
1,666.7.
76. Yeah.
Okay. So I'll mark this as 1,001,667. So ideally we should, have the collateral of 1,01667. 1,001,667. But that means collateral is less now. Less by how much? Take the difference. Less by how much?
Less 972,492, right?
No, these two difference. 990,000 minus
Yeah, 1 million.
1,001,667. 1,001,667.
Yeah, it's to 29,174.76.
How 29,000? See, 990,000,
Okay,
and here it is
990,000. Sorry.
1,000. So the difference is around 11,667. 11,667. So the collateral is falling short by 11,667. The collateral is falling short by 11,667. So now who will be worried? Borrower will be worried or lender will be worried?
Lender, right?
Lender will be worried. So lender will ask the borrower to
For
pay
this
this much
additional
of
amount.
money.
Yeah.
Okay, this amount is called as variation margin. That means based on the change in the collateral, the amount that is needed to be filled up is called as variation margin. Variation margin. Have you understood this sum now?
Yes, sir.
Okay, now you have to practice this at home. Okay, now should it be like 990,000 only. What if, this would have gone to, say, for example, now borrowed amount is 972,492, right? Okay, let's say this is the situation. Borrower, it looks like borrower has borrowed 972,492, and lender, here instead of 990,000, suppose if the value of the collateral has gone up, say something like uh, 1,015,000. Okay, 1,015,000. Now let's see what happens. For 100, if you are borrowing 100, then what should be the collateral? Collateral should be 103. But now, if you have borrowed 972,492, what should be the collateral? So it will be 972,492 into 103 divided by 100. Calculate this, cross multiply.
It is 1,01,666.76. It's the same.
1,001,000 is the same.
Triple six, yeah, 666.76. It's the same calculation. Uh,
Acha, sorry. Yeah, it will come to the same calculation, right? Okay, yeah. 1,001,667,
six,
right? Okay,
yeah,
1,001,667, correct. So 1,001,667, but now how much is the amount? It is 1,015,000. So how much is the difference? How much is the difference between these two?
13,333.24.
13,000.
333.24.
So now who will be worried with this amount? Will the lender be worried here? See, this only should be the collateral. What is the collateral? 1015
Yeah,
triple
so
zero.
the borrower should be worried. The
Yeah,
borrower has to
yeah.
pay back to the lender.
See, borrower is over collateralized in this case. Borrower will say,
Sorry,
look,
sorry.
I am supposed to collateralize only
Lender.
1,001,667.
Yeah,
So borrower will say, I have over collateralized. So he will ask this money from the
yeah.
lender.
So lender has to pay back this money.
Now lender has to pay. Okay. Now I forgot to tell you a couple of other terminologies also here. Those terminologies are haircut. Okay. Haircut means, okay, so I'll write here only haircut, or I'll write here haircut. Yeah. So haircut is the difference between the value of the collateral and minus the borrowed money. Okay, borrowed amount. Collateral's value is 1 million and borrowed amount is 970,874. So 1 million minus 970,874. How much is the difference?
29,126.
So this is called a haircut. Now we can find out haircut, in another way also, haircut percentage. So yeah, so if I want to convert this into percentage, so haircut percentage is equal to, this is the amount based on collateral value. So this haircut amount divided by collateral value into 100 will give me 2.91 percentage.
Yeah.
Okay. Now there is another way also. Now haircut percentage is equal to, haircut percentage is equal to 1 minus 1 by initial margin. 1 minus 1 by initial margin means here it is out of 1. Okay. So I said for 100 borrowing, initial margin is 103. That means it is 1.01. Okay. For on the basis of 1. So it is 1.01. So for 1, it will be 1.01. Sorry, not 1.01, 1.03. 1.03 for 1. Now you calculate this. What is this 1 by 1.03?
This is 0.9708.
Now you do 1 minus 0.9708.
This is 0.02913.
Yeah, so that is equal to 2.91 percentage. It's 2.91 percentage. Okay, so haircut. Okay, so okay, you will have to practice this, and then you will get better. But if you practice, you will understand. It's not that tough also. Then you don't have to read all these things. Okay, if you practice, it is enough. Then some other terminologies. Repo is shortly, repo is only called as repurchase agreement. Now, if it is, borrowed only for 1 day, it is called overnight repo. If it is borrowed for longer than 1 day, it is called term repo. Okay. Then some other terms: general collateralized repo and master repurchase agreement. Okay. Repurchase agreement means where all the terms of the repo are mentioned. Um, Now, what is general collateral repo? The collateral used in the repo may involve a specific security or general type of security, like treasury bonds of a certain range of maturities, in which case it is called general collateral repo. Okay, these are all normal thing. Okay. Then these are the uses of repurchase agreement. Now, out of this is very interesting one: short selling. So hedge funds, they participate in it. So why hedge funds act as the lender here? So hedge fund is the lender. So there is a borrower, there is a lender, and who is this lender? Hedge funds. Now hedge funds, what do? Basically, they take a lot of risk. Hedge fund, similar to mutual funds, but not mutual funds. Okay, they take money from rich people and then they invest into various securities. They take a lot of risk. Now, why do they participate? So their strategy is what, give 100, take 103. Now, what will they do? This 103 has to be returned after 3 months only. That means this bond. Imagine this is some collateral, which is some bond, and they expect this bond's price to come down in the market. So, what will they do? They will take this, bond from the borrower, and then they will sell it in the market. Short selling. Okay, short selling. That means they will sell it in the market. Okay, let's say its value is now 103. Then after 90 days, when they are supposed to return, because ideally the borrower will repay, right? The loan plus interest, and he will take back his collateral, that is bond. So that time, imagine the in the market the price has come to 102 or 101 rupees. So they will buy it from the market at 102, and that they will give it to the borrower. So they are automatically getting, some profit over here, because the borrower is borrowing 100, but the borrower will pay more, right? That is the repo rate he will pay. Plus they are earning here as well. So they sold at 103, they will buy at 102 in the market. So net they got 1 rupee here also outside. So they take such kind of risk. Okay.
So why would someone buy from them? Like if they know the maturity amount would be less than what they're paying right now.
I haven't understood. Why would
Like
somebody buy from whom? From the hedge
uh,
funds?
from the hedge funds, yeah. Like if at the maturity, like if they'll pay the borrower will pay 102. So why would someone buy at 103?
Okay, so there is a buyer who is buying this. Okay, and here they are selling. It is their expectation that in the market the interest rates will go up and bond price will come down. Remember, we learned that
Yeah.
inverse relationship. So this is their expectation that interest rates will go up in the next 90 days
Hmm.
and the bond price will come down. Now
So it is
everybody will have different opinion now in the market, right? Whether
so
the
it is
interest rate
it
will
is
go up or not.
it is the hedge fund's expectations that the
Yes,
price will come down.
yes.
Okay.
So when the interest rate goes up, price will come down, and then they will, assuming market goes as per their predictions, they will buy it from the market and then they will give it to the borrower back.
Okay.
So borrower is also happy. The hedge fund also made more money here.
Right. Yeah.
Okay.
Perfect.
Yeah. Rest is all normal thing which when you read you should be able to understand. This is that buybacks. This not buyback. This short selling story given here. First you lend in a repo. Buy securities means get these securities. Treasury, get this bond, and then lend it in the repo, then short sell the securities in the open market, then buy back the securities in the open market later, and deliver the securities back to the repo counterparty. Repo counterparty means borrower at the maturity of the repo. Okay. The short seller engaging in this kind of transaction just described will need to specify security they wish to borrow, known as special trade. Okay. That means this is the special trade. This bond will come under special trade. Okay. Factors affecting repo rate. These are all interest rates, higher interest rate. These are all, I think, when you read, you should be able to get it. Factors affecting interest rate, repo risk. I have not seen any questions in all these things, and even if you get questions, also if you understand the concepts, you should be able to get the answer as well. Okay, triparty repo means uh, nothing. This in this case, repo means normally borrower and seller, borrower and lender are meeting. Tri-party means borrower doesn't know the lender. There will be one third party in between. So now it becomes tri-party. Okay, so this person is connecting X and Y. That is tri-party repo. Otherwise, it is bilateral repo. Directly, if X and Y are connecting, then it is bilateral repo. Yeah, I think it is fine till here today. The next
Yes.
one is reading 51, um, fixed income markets for government issuers. I think this is after this, all sums will begin. I think after this, Yeah, from here it will be more interesting to do sums. So then just one more small reading, theoretical. After that, all sums will be there. Today, anyways, we did one sum. Okay, fine. So we'll stop now here. Okay.
Okay, sir.
Yeah.
Thank you,
Okay.
sir.
Okay. Bye.
Bye. Bye.